Hey everyone, just want to share some thoughts around the MASFAA conference, or Massachusetts Association of Student Financial Aid Administrators conference that I attended last week. Now, the MASFAA conference is the financial aid people from Massachusetts colleges and universities, their annual conference. And the overarching topic of this year's conference was the One Big Beautiful Bill Act, which was signed into law on July 4th. And without going over the entire thing, but the one issue that it was basically discussing as of concern to everyone at the conference was the limits on how much students and parents can borrow, both at the undergraduate level as well as the graduate level, though I will tell you that most of the discussion was around the graduate level. And just as a reminder, once the law goes fully into effect as of July 1 of 2026, parents can only borrow up to $20,000 per year for undergraduate on a Parent Plus loan with a $65,000 lifetime limit, and that the graduate level students can only borrow $20,500 per year and up to $100,000 lifetime limit for a graduate program, or they can borrow up to $50,000 per year with a $200,000 annual lifetime limit on a professional program. So, of course, the question then becomes, and there's been quite a bit of lobbying around what makes for a graduate program versus professional program. And this is something that I heard of but didn't really know that clearly, but apparently in the law, there is that difference already. It just didn't matter before because whether you were studying a graduate program or a so-called professional program, you could borrow the same amount. So quite frankly, that designation didn't matter. But now it does. And so among the professional programs are things like medical school, medicine, vet, dental, law, things like that. Some of the programs that you would think are so-called professional, but really not, are like nursing, physician's assistant, or even teachers. So there's been a lot of concern around the fact that nursing is not considered a professional designation, but the point is that it never was to begin with in the eyes of the regulations, but just previously it didn't matter. Of course, with the limits on borrowing, the concern is enrollment, right? The schools are pretty open about this. Now, schools today know how much their students borrow in using graduate student loans because it's revenue to the school, right? That's how the students are able to enroll. But what they don't know is the credit profiles of those students because for federal student loans, there's basically no credit check. So if graduate loans are now limited in the amount that people can borrow, and students and families have to turn to private lenders, and private lenders will do full underwriting, meaning credit score, debt to income, things like that. The schools don't know how many students will credit qualify, will get approved for these loans. And if they're not approved for these loans, will they still find another way to enroll? Or will they simply not go to school, to these graduate or professional programs? Nobody really knows the impact on enrollment. So there's a lot of uncertainty, so there's a lot of concern, and this could either be a gigantic issue, as I think it probably will be, or it could be a nothing, right? We just don't know yet. So schools and lenders are exploring a lot of different options. And so one of the things that some schools are looking at potentially is what if they started their graduate programs, and when I say graduate, I mean graduate and professional, but what if they started their programs a month early? So normally, their programs don't start till August or September of each year, typical start of a school year. But what if they started it, let's say in June of 2026, a month before this law takes effect? So that means that the students starting that program a month before the law takes effect, then for 1 year, these students would get grandfathered into the old lending limits, which were you could borrow all the way up to the cost of attendance. And so essentially the schools are able to just sort of kick this problem down the road for a year. Now, there's all sorts of operational issues with that. So it's not just like, hey, I think I'm going to decide to start this early, right? Like there's a lot that schools would need to do to make that happen. Some schools potentially even looking at what's called risk sharing, where they would share the risk in students not being able to pay their loans with the lender. So basically, if a student goes through the program, doesn't get a job, or for whatever reason graduates and then chooses not to pay or is unable to pay the loan, normally that lender would take the loss, but some schools are potentially looking at sharing that loss to encourage that lender to provide more loans so students can attend that school. There's also some lenders looking at outcomes-based loans, and so really lending based on projected income in that field, right? There is one lender that already does this to a small degree, but that could be a possibility down the road for other lenders as well. And there can be differences by school or program. So for example, if you go to a graduate program one school, you might have an easier time qualifying for a loan because maybe they have less stringent credit score requirements or debt to income requirements, or may not need a cosigner than if you did the same program but at another school. And there's even the potential of having different programs within the school have different requirements. So schools and lenders are looking at all of these different possibilities. It's just nobody knows kind of where it's going to go next year because the world is so uncertain because again, nobody knows, and schools don't know how many kids are going to qualify for these private loans, or if they're going to use them. And if they don't qualify, how many of them will still show up by paying some other way. One of the things that was briefly discussed, although it didn't come up very often, was the issue of income-driven repayment plans. Now, in federal student loans, borrowers have access to income-driven repayment plans. Essentially, what that means is their payment can vary by how much money they're making, right? If they make more, their payments go higher. If they make less, their payments are lower. But that is really not available in the private student loan market. I'm only aware of one lender that even offers a version of this, but no one really talked about this much because it's unlikely to happen in the private student loan market, because when you have a payment that can vary, right? It goes from this number to this number, 1 year to the next, then the lenders don't really know when they're actually going to get their loan paid back. Right? So it's not like a 30-year mortgage where if you make the same payment every month for the 30 years, that last payment's going to pay off the loan. But when the loan payment can vary, you don't know if you're going to get your money back in 5 years or 10 years or 30 years. And so as private entities, it would be very hard for a lender to say, yeah, we're going to make this loan to the student, but we're not quite sure when we're going to get paid back. The stockholders, investors, and the management team of those lenders, they're going to want a little bit more certainty than that. So what can families do right now? Well, until some of these things shake out, it's hard to know. But what families can do are a couple things. Number one is be much more aware of how much programs cost, because if you're going to have to borrow beyond the federal limit, that could be a problem. Number two is check your own credit profile. And I mean by credit profile is that your credit score and your debt to income ratio. And I know a lot of people focus on credit score. And yes, it is important, but you can have a really good credit score, but if you don't have enough income to show a lender that you can actually afford to make the payments on another loan, then you're probably not getting another loan. And this is true for both students and parents, because students will need to look for themselves. But because of this new world, because of this law, parents are likely to have to co-sign for any loans to students at the graduate level. And then the parents' credit score and debt to income ratio will come into play. So these things need to be known. And if you can take the time to improve them, now's the time to do it. As always, stay safe, stay healthy, and I'll see you next time.